Physical properties versus real estate investment trusts. Where should you invest? Starting capital, management, revenue potential, liquidity. Finally, you've decided to take the plunge into the real estate industry. In a nutshell, there are two routes: physical properties and real estate investment trusts. Obviously, you would need money to start your investment. When you buy physical properties, it would require a lot more capital. Affordable condos for sale in Makati will have a price tag of 3 million to 5 million pesos. If you're taking the flip and sell approach for a foreclosed property, you might have to allocate at least 1 million pesos for the remodeling. The bottom line is that you must come up with a huge amount of money or take out a big loan to start your investment. On the other hand, when you choose real estate investment trust, you'll be cashing in a lot less. For example, REIT, which is sponsored by Ayala Land, is sold at 33 pesos per share. Real estate investment trust eligible stockbrokers in the country often have a minimum starting capital of 5,000 pesos. Compared to buying physical properties, investing in real estate investment trust is more affordable. If you have ready cash or can bear the long-term payments on a property loan, go for physical properties. Aside from financial capacity, you must also consider your competence and availability when it comes to managing your investments. As you know, maintaining a rental condo or selling a house would take a lot of time and require a lot of skills, from negotiation and organization to marketing. In real estate investment trust, on the other hand, there's little management needed on your end, precisely because it's the property company involved in that. They're the ones overseeing repairs, screening and dealing with tenants, hiring contractors, and more. If you have time, energy, and skills to be hands-on in the management of your investments, go for physical properties. But if you'll be juggling a full-time day job and family responsibilities, it would be wiser to consider real estate investment trust. Both physical properties and real estate investment trust can be excellent income-generating assets. In a rental condo, for instance, the revenue comes from the monthly rental payments from tenants. You get to make money from capital appreciation as well. Meanwhile, in real estate investment trust, you get to earn through dividends. Companies are required by the law to pay at least 90% of their distributable annual income as dividends to their shareholders. If you're an overseas Filipino worker, you can get tax-free dividends for 6 more years. However, it's important to note your expenditures and risks to determine the full picture of your asset's revenue potential. In a physical property, you need to pay for insurance, taxes, and maintenance. In real estate investment trust, on the other hand, the prices of shares fall when interest rates go up, and when there's political instability and economic recession. Take note of these expenditures and risks when projecting the revenue potential of the asset you're buying. How easy will it be for your asset to be converted into cash? This is another consideration when it comes to real estate investments. In the case of physical properties, it's illiquid compared to real estate investment trust. Selling a piece of land, for instance, would take a few months or years, which is a bit inconvenient when you badly need cash. Real estate investment trust, on the other hand, are highly liquid since they are like publicly traded stocks, which you can sell fast. So, where should you invest your hard-earned money? The answer lies in your financial capacity, skills, need for cash, and other factors. A wise investor would look at different aspects to make a sound decision.